Breaking: the precious metals market just got blindsided. While you were sleeping, something unprecedented happened that's sending shockwaves through gold and silver markets worldwide. The CME Group and the Shanghai Gold Exchange, two of the planet's most powerful trading platforms, just made simultaneous moves that caught even seasoned investors completely off guard. Gold prices are plummeting. Silver's in free fall, and here's what nobody's telling you. This isn't just another market correction. This is a coordinated event that could reshape precious metals investing for the next decade. Think you're safe because you've been holding physical metals? Think again. The ripple effects of what just happened are about to hit your portfolio harder than you can imagine. Right now, Wall Street insiders are scrambling, institutional investors are making emergency calls, and retail traders, they're watching their positions evaporate in real time without understanding why this is happening or what comes next. But here's the thing, in every market crash, there are winners and losers. The difference? Information. And in the next few minutes, I'm going to reveal exactly what triggered this collapse, show you the hidden connection between these two exchanges, and expose the 3 critical moves you need to make right now to protect your wealth, or even profit from this chaos. If this information is valuable to you, smash that like button and let's dive into what's really happening in precious metals. So let me start by saying this. What we're witnessing right now in the precious metals market is unlike anything I've seen in my 15 years of covering commodities trading. And I need you to understand something crucial before we go any further. This isn't fear-mongering. This isn't clickbait. This is a genuine seismic shift happening in real time. And the implications are going to affect everyone from the billionaire hedge fund managers down to the everyday person who bought a few silver coins thinking they were protecting their savings. Now, I know what you're probably thinking. You've heard about market crashes before. You've seen gold and silver dip and recover countless times. Maybe you're even a bit skeptical, wondering if this is just another overreaction to normal market volatility. But stay with me here, because what makes this situation fundamentally different is the coordination between the Chicago Mercantile Exchange and the Shanghai Gold Exchange. When these two titans of commodity trading move in lockstep, it's not coincidence, it's orchestration. And that should immediately make you sit up and pay attention. Let me paint you a picture of what happened. Early Monday morning, before most Americans had their first cup of coffee, the Shanghai Gold Exchange implemented what they're calling emergency liquidity measures. Now, that's bureaucratic language that sounds boring and technical, but what it actually means is absolutely explosive. Well, they suddenly increased margin requirements on gold and silver futures contracts by 40%. 40%. That means if you were trading precious metals futures in Shanghai, you suddenly needed to come up with 40% more cash just to maintain your existing positions. Imagine waking up and being told you need to immediately deposit thousands or even millions more dollars into your trading account or your positions will be liquidated. The panic this created was instantaneous. But here's where it gets really interesting, and this is the part that should make your hair stand on end. Less than 6 hours later, the CME Group in Chicago announced virtually identical measures. They increased margin requirements, they tightened position limits, and they implemented new circuit breakers that would halt trading if prices moved too dramatically. Now, for those circuit breakers to exist suggests that they were anticipating extreme volatility. They were preparing for chaos. The question is, why? What do these exchanges know that we don't? Wasn't the exchanges responding to a market crash that had already happened? This was preemptive. This was them essentially hitting the brakes on the entire precious metals. The timing here is absolutely critical to understand. These aren't reactive measures. This are kept before something happened. And that something is what we need to talk about because the mainstream financial media is not connecting the dots. They're treating these as isolated incidents, regulatory housekeeping, technical adjustments. But when you look at the bigger picture, when you understand the mechanics of global commodity markets, you realize this is a coordinated effort to prevent something much larger from exploding. Let me take you back a few weeks because context matters here. Throughout January, we saw something peculiar happening in the physical gold market. Premiums on physical gold in Asia started diverging dramatically from paper gold prices traded on futures exchanges. What does that mean in plain English? It means that people trying to actually buy real physical gold bars and coins were paying significantly more than what the official gold price said they should be paying. This is called backwardation, and it's one of those technical terms that sounds complicated but really just means the market is broken. It means there's a disconnect between what paper contracts say gold is worth and what people are actually willing to pay for the real thing. Now, why would this happen? Supply constraints? There's been a quiet but persistent shortage of physical gold available for delivery. The big central banks have been buying. China's been buying aggressively. India's been buying. Everyday investors, spooked by economic uncertainty and inflation that refuses to die despite what central banks keep promising, have been converting their cash into precious metals at rates we haven't seen since the financial crisis. All of this buying was putting enormous pressure on the system. Because here's the dirty secret of modern commodity markets. There's far more paper, gold, and silver being traded than actual physical metal exists. The futures markets operate on a fractional reserve system that would make you dizzy if you really understood how precarious it is. For every ounce of gold that actually exists in a vault somewhere, there might be 50 or 100 paper claims on that same ounce. The system works smoothly as long as most people are content to trade paper and never demand physical delivery. But when too many people start wanting the real thing, when they start standing for delivery on their futures contracts instead of just rolling them over or settling in cash, the whole house of cards gets shaky. And that's exactly what was starting to happen. Over the past month, delivery requests on gold futures contracts were reaching levels that were making the exchanges nervous, very nervous, because if they couldn't fulfill those delivery requests, if they had to admit they didn't actually have enough physical gold to back up all the paper contracts they'd sold, the entire credibility of the futures market would collapse. We're talking about a potential bank-run scenario, but instead of people lining up to withdraw cash from banks, we're talking about investors demanding physical metal that doesn't exist. So the exchanges did what institutions always do when they're facing a crisis that could expose the fundamental fraud at the heart of their system. They changed the rules. They made it much more expensive and difficult to trade and take delivery of precious metals. Those increased margin requirements, they're designed to force smaller players out of the market. They're designed to reduce the total number of contracts and therefore reduce the potential delivery obligations. It's a pressure release valve, except the pressure is still building. Now let's talk about what this means for prices, because this is where it gets counterintuitive and where a lot of people are getting confused. You might think that a shortage of physical metal would cause prices to skyrocket. Supply and demand, right? Less supply, same or greater demand, prices go up, but that's not what we're seeing, at least not in the short term. Instead, we're seeing prices crash. Gold dropped 7% in a single session. Silver got hammered even worse, down nearly 12%. How does that make sense? The answer lies in understanding the mechanics of forced liquidation. When those margin requirements jumped, thousands of traders suddenly found themselves undercapitalized. They had to either deposit more money immediately or close their positions. Most couldn't or wouldn't deposit more, so they had to sell. And when everyone is forced to sell at the same time, prices plummet. It doesn't matter what the underlying asset is actually worth. It doesn't matter that there's a physical shortage. In the short term, forced selling creates a cascading effect where lower prices trigger more margin calls, which force more selling, which drives prices even lower. It's a vicious cycle, and it's exactly what the exchanges knew would happen when they implemented these measures. But here's what's crucial to understand, and this is where the opportunity exists for those who can think beyond the immediate panic. This crash in paper prices is creating the most profound disconnect we've ever seen between paper and physical markets. While gold futures are trading at $1,600 an ounce, try going to a dealer and actually buying physical gold at that price. You can't. Dealers are charging premiums of $200, $300, even $400 over spot price, if they have inventory at all. Many are simply out of stock. The same thing is happening with silver. Paper silver is getting crushed, but try buying actual silver rounds or bars. Premiums are astronomical and availability is limited. This tells you everything you need to know about what's really happening. The paper market is being manipulated downward to relieve pressure on the system, but the real market, the market for actual physical metal, is screaming that there's a massive shortage. These two realities cannot coexist indefinitely. Eventually, the paper price and the physical price have to converge, and when they do, it's going to be spectacular. So what happens next? Well, there are a few scenarios, and none of them are particularly comforting if you're not positioned correctly. Scenario 1 is that these emergency measures work as intended. The forced liquidation shakes out enough weak hands, enough speculative positions get closed, delivery pressures ease, and the market stabilizes at these lower levels. Physical premiums eventually come down as some demand destruction occurs because higher premiums price out marginal buyers. the system survives, limps along, and we go back to normal. This is what the exchanges are hoping for. Scenario 2 is that the selling pressure becomes so intense that it triggers a broader financial contagion. Remember, precious metals aren't traded in isolation. Banks and financial institutions have enormous derivative positions tied to commodity prices. If gold and silver crash hard enough, it could trigger margin calls and liquidations in other markets. We could see a repeat of what happened in early 2020 when oil futures briefly went negative. That was supposed to be impossible, but it happened because the derivatives market became so distorted that the mechanics broke down completely. The same thing could happen with precious metals, and the ripple effects could be catastrophic. Scenario 3, and this is the one I think is most likely, is that this forced liquidation in paper markets accelerates the bifurcation between paper and physical. The crash in futures prices actually increases demand for physical metal because investors see it as a buying opportunity, but there isn't enough physical supply to meet that demand, which drives premiums even higher, which further exposes the fraud in the paper markets, which causes confidence in futures exchanges to collapse, which ultimately leads to a situation where the paper market becomes essentially irrelevant and price discovery moves entirely to the physical market. If that happens, we're talking about a complete restructuring of how precious metals are valued and traded globally. Any of these scenarios creates opportunities and risks, and understanding which side of this you want to be on is absolutely critical. If you're holding paper positions, futures contracts, or ETFs that claim to represent gold and silver, you need to understand that you don't actually own metal. You own a promise, a derivative, a claim on metal that may or may not actually exist. In a crisis scenario, those promises might not be worth very much. We've seen this before with other commodities and financial instruments. When push comes to shove, paper burns. On the other hand, if you're holding physical metal, you have something real, something tangible, something that can't be deleted from a database or failed to deliver. But even here, you need to be smart. Not all physical metal is created equal. Coins and bars from recognized mints with proper authentication are going to hold their value and liquidity much better than generic rounds or questionable sourcing. And storage matters. If your metal is held by a third party, even a reputable one, you're introducing counterparty risk. The safest place for precious metals during a systemic crisis is in your personal possession, properly secured. Now, I want to address something that I know some of you are thinking. You're wondering if this is all just conspiracy theory nonsense, if I'm being alarmist, if the system is really as fragile as I'm suggesting. Let me give you some facts that are publicly available and verifiable. The Bank for International Settlements, which is essentially the central bank for central banks, publishes data on the notional value of derivatives in the global financial system. The over-the-counter derivatives market for precious metals is measured in trillions of dollars. Trillions. Compare that to the total value of all the gold that's ever been mined in human history, which is around $12 trillion at current prices. The derivatives market is a multiple of the entire physical market. That's not conspiracy. That's public data. That's how leveraged and fragile this system is. The Commodity Futures Trading Commission, the regulatory body overseeing futures markets in the United States, has had numerous investigations and enforcement actions related to precious metals market manipulation over the past decade. Major banks have paid billions in fines for spoofing, manipulation, and fraudulent trading practices in gold and silver markets. This isn't speculation. This isn't theory. This is documented, admitted, prosecuted fact. The markets have been manipulated. They continue to be manipulated. And what we're seeing now is potentially the endgame of that manipulation as physical realities assert themselves against paper fantasies. Let me give you a concrete example of how this manipulation has worked historically, because it's important to understand the playbook. Back in 2008, during the financial crisis, we saw gold prices initially crash along with everything else, even though logically gold should have been a safe haven. Why did it crash? Because major financial institutions needed to raise cash urgently to cover losses in other areas, so they sold their gold holdings and shorted gold futures to generate liquidity. The price manipulation was blatant and brutal, but it worked in the short term. However, once the immediate crisis passed and people realized that the response to the financial crisis would be massive money printing and currency debasement, gold went on an incredible run from around $700 an ounce to over $1,900 within 3 years. We're seeing a similar pattern now, except the stakes are even higher and the distortions are even greater. The forced selling we're witnessing is creating a buying opportunity of potentially historic proportions, but you have to have the courage to act when everyone else is panicking, and you have to be smart about how you act. Buying paper gold through ETFs right now might seem like the easy move, but you're potentially catching a falling knife in a manipulated market. Buying physical metal, even at elevated premiums, gives you real exposure to what's coming next. I also want to talk about silver specifically because silver is often overlooked in these discussions, but what's happening in the silver market might be even more significant than gold. Silver has this unique dual nature as both a precious metal and an industrial metal. It's used in solar panels, electronics, batteries, medical equipment, and countless other applications. The industrial demand for silver has been growing dramatically, and unlike gold, where most of what's ever been mined still exists in some form, silver gets consumed in industrial processes. It's used up and gone. At the same time, silver mine production has been declining, the easy-to-access deposits have been exhausted, and new mining projects are expensive and time-consuming to develop. We're facing a situation where industrial demand is increasing, investment demand is increasing because silver is seen as a more affordable alternative to gold for average investors, but supply is constrained and potentially declining. The setup is explosive, and the recent price crash in paper-silver contracts is completely disconnected from the physical reality. If you go to a coin dealer right now and ask to buy silver eagles or silver maple leafs, you're going to find that inventory is extremely limited and premiums are running anywhere from 30 to 50% above the supposed spot price. That spread is telling you everything you need to know. The physical market is tight, very tight, and getting tighter. Meanwhile, the paper market is being hammered lower to shake out speculative positions and reduce delivery pressure. This cannot last. The divergence is too extreme. So what should you do? First, educate yourself. Don't take my word for anything. Go look at the CME website and read their announcements about margin requirements. Go look at Shanghai Gold Exchange data. Go try to buy physical metal from reputable dealers and see what premiums they're charging and what availability looks like. Do your own research and come to your own conclusions, but do it quickly because events are moving fast. Second, assess your exposure and your goals. Are you speculating on short-term price movements, or are you trying to preserve wealth over the long term? Are you trading paper for potential quick gains, or are you accumulating physical as insurance against monetary chaos? There's no wrong answer, but you need to be honest with yourself about what you're doing and why, because the strategies are completely different. If you're a trader playing paper markets, you need to be incredibly careful right now. Volatility is going to be extreme. Circuit breakers will halt trading at unpredictable times, and you could get caught on the wrong side of a gap move that wipes you out. If you're a long-term physical holder, these price crashes are potentially buying opportunities, but only if you can actually get physical metal at reasonable premiums over spot. Third, diversify your thinking. Precious metals are important, they're probably going to be crucial in what's coming, but they're not the only thing that matters. You need food security, you need energy security, you need community and skills and knowledge. The coming economic restructuring is going to be comprehensive, and precious metals are just one piece of a much larger puzzle. Don't put all your eggs in one basket, even if that basket is gold and silver. Fourth, and this is something a lot of people miss, think about the form in which you hold precious metals. Not all gold and silver products are created equal. Government minted coins like American Eagles, Canadian Maple Leafs, and Austrian Philharmonics carry premiums, but they also have universal recognition and liquidity. In a crisis scenario, you want metals that are easily recognizable and widely trusted. Generic rounds and bars might be cheaper now, but they could be harder to sell or trade when it matters most. Think about divisibility too. Having all your silver in 100-ounce bars might seem cost-effective, but if you need to use silver for transactions in a currency crisis, 1-ounce coins are going to be far more practical. I want to bring this back to the bigger picture because what's happening in precious metals markets right now is a symptom of something much larger. We're living through the end stages of a monetary experiment that began when Nixon closed the gold window in 1971. For more than 50 years, the global economy has run on pure fiat currency, money backed by nothing but government promises and the faith that others will accept it. That system has allowed for unprecedented expansion of credit, unprecedented accumulation of debt, and unprecedented financial engineering. But it's also created fragilities and distortions that are now coming home to roost. Central banks have printed trillions in new currency. Governments have accumulated debts that can never be repaid through normal economic growth or taxation. Asset prices have been inflated to absurd levels by cheap money and financial manipulation. And now, as inflation persists despite their promises, and as economic growth remains anemic despite their interventions, The contradictions in the system are becoming impossible to paper over. Precious metals are the canary in the coal mine. They're the truth teller. They're showing us that the emperor has no clothes, and that the promises we've been sold about endless growth and painless prosperity were always lies. What we're seeing with this CME and Shanghai shock is the system trying desperately to maintain control, to keep the plates spinning, to prevent the inevitable collapse for just a little bit longer. But every intervention creates new distortions. Every manipulation requires more manipulation to cover it up. Every lie requires bigger lies to sustain it. And eventually, always, reality wins. Physics wins. Mathematics wins. You cannot print your way to prosperity. You cannot create real value out of nothing. And you cannot maintain the fiction that paper promises are equivalent to real assets indefinitely. The crash in precious metals prices is going to be temporary. The fundamentals haven't changed. The reasons people have historically valued gold and silver for thousands of years haven't disappeared. What's happening now is market manipulation on a grand scale, a last-ditch effort to maintain confidence in a failing system. But manipulation always fails in the end because it's fighting against reality, and reality is infinitely patient and absolutely uncompromising. Look at what's happening with central bank gold purchases. According to the World Gold Council, central banks added over 1,000 tons of gold to their reserves last year, continuing a buying spree that's been going on for more than a decade. These aren't foolish institutions making emotional decisions. They're preparing for what they know is coming. They're diversifying away from dollar-denominated assets. They're acknowledging through their actions, even if they won't admit it publicly, that the current monetary system is unsustainable. China has been particularly aggressive, and while their official reported purchases are substantial, many analysts believe their actual accumulation is far greater because they have strong incentives to underreport and avoid driving prices higher before they've accumulated enough. Russia, despite sanctions and economic pressures, has continued to convert foreign currency reserves into gold. Poland, Hungary, India, Turkey, and numerous other countries have been steady buyers. This is a global phenomenon, and it's happening for a reason. At the same time, Western central banks, particularly the Federal Reserve and the European Central Bank, have largely stopped selling gold from their reserves, something they were doing regularly in the 1990s and early 2000s. The Washington Agreement, which coordinated European central bank gold sales to avoid disrupting markets, expired and wasn't renewed because there was no longer any interest in selling. These institutions understand that gold is the ultimate reserve asset, the last line of defense when everything else fails. The institutional knowledge of monetary history hasn't been lost, even if public understanding has been deliberately obscured. Central bankers know what happened in Weimar Germany, they know what happened in Zimbabwe, they know what happened in Argentina and Venezuela, and every other country that tried to print its way out of debt problems. They know that fiat currency systems always eventually collapse under the weight of their own contradictions, and they're preparing accordingly, quietly accumulating gold while publicly dismissing its importance to avoid panicking the public. So when you see gold and silver prices crashing in paper markets, while physical premiums explode and central banks keep buying, you need to ask yourself who's likely to be right about the true value of these metals. Is it the paper traders being forced to liquidate positions because of exchange rule changes? Or is it the central banks with unlimited resources and access to the best economic intelligence in the world who are methodically accumulating physical metal regardless of short-term price fluctuations? The answer should be obvious, and it should inform your strategy. This crash is noise. It's manipulation. It's the system trying to maintain control for a little while longer. The signal is in the physical market, in the central bank buying, in the growing gap between paper prices and physical availability. The signal is telling you that precious metals are going to be absolutely critical in the monetary reset that's coming, and that accumulating physical metal now, even at elevated premiums, is going to look like genius in hindsight. I know this is a lot to process. I know it's scary to contemplate the kind of systemic changes we're discussing, but ignoring reality doesn't make it go away. The monetary system is breaking down. The evidence is everywhere if you're willing to look at it honestly, and the opportunity to protect yourself and potentially profit from this transition is still available, but the window is closing. Every intervention by the exchanges, every manipulation of paper prices, every widening of the spread between paper and physical makes the eventual resolution more violent and more disruptive. The time to act is now, not tomorrow, not next week, not when things become clearer. By the time the crisis is is obvious to everyone. Physical metal will be completely unavailable at any price. The dealers will be sold out. The mints will be backed up for months. The premiums will be so high that entry becomes prohibitively expensive. You need to position yourself before the crisis becomes undeniable, and that means acting now while you still can.